All right, so for this next session, I got to tell you that the words turbulent markets were not actually there when we first started programming this thing. But things have changed and you have to roll with the changes. So to lead us in this discussion, which is a bit of a look at where people should be investing in this environment, Taylor Culbertson will be the moderator. We've got Jeff Dorman from Arca, David Duong from Coinbase, and Liz Young from SoFi. Please welcome them to the stage. I'm going to need an extra chair. So we can bet that extra chair, please. Thank you. Welcome.
Thank you.
Thanks, guys. Good luck.
Thank you. Hopefully we don't need that.
Yeah, well.
Good morning.
Good morning. All right. Over to you, Taylor.
Good morning. All right. Everybody, I'm Taylor. I'm going to be the moderator here for the panel. I'm also the CEO of Hedgehog. What's Hedgehog? It's a great first question, Taylor. We were the first company that was registered with the SEC to provide personalized crypto advice in the US with our upcoming launch. Essentially, you're going to be able to build your own custom ETF, auto-rebalance all of your funds, and take advantage of a best price trading system. But why did I lead with that? Partially because I think I'm contractually obligated to get my plug-in at the beginning of the panel. But secondly, honestly, I kind of felt the need to justify why I'm here on what I would consider to be a very stacked panel. We have Liz Young, who's the head of investment strategy at SoFi. You can catch her on CNBC, I don't know, every other day kind of thing. We have David Duong from Coinbase, the head of institutional research. And then we have Jeff Dorman, who is a co-founder and chief investment officer at Arca. So basically, we're here to discuss two different things. The first is digital investments and how to build your portfolio in the modern age and how that has sort of changed over the last 10 years. And then we're here to talk about the turbulent market and sort of our outlook on it. We'll talk a little bit about inflation, interest rates, maybe a little bit about regulations. They might have covered that fairly well there. And hopefully we'll be able to walk away with some ideas about what is affecting our portfolios, how it's affecting it, and what we might be able to do. So to kick it off, Liz, you're kind of our de facto traditional finance representative up here.
Yeah, they call that TradFi.
TradFi.
Yeah.
Right?
Yeah.
So as crypto came to the rise, it kind of changed a lot of things in finance. From an institutional level, what are some of the biggest changes that you've seen take hold of?
So first, I'm really excited for this microphone challenge. I feel like we're up here doing an experiment. I mean, a ton has changed, and I think maybe one of the ways that I would frame it is I made a big transition from TradFi. I had spent all of my career up until I came to SoFi in really traditional either asset management companies or banks. And SoFi is actually the first company, the fourth company I've ever worked for, but the first one that was less than 100 years old. So making that transition for me was eye-opening, a little terrifying, but eye-opening. And I got to the company and I got to talk to some of these newer investors, and just to frame that too, about 60% of our investing platform is between the ages of 20 and 40. So it skews way younger, and you compare that to a traditional asset management company, your average client is somewhere in between 55 and 65, right? And the average financial advisor is between the same ages. So I went way younger, and it was fascinating just to hear what they were interested in, right? And the ways that the industry had changed. And one of the reasons that I made that leap was because you could feel it. You could feel the shift going on, and you could feel this change in the individual investor and this huge community that had started to build around crypto and around all the different ways that you could invest and be creative about it today in a portfolio that sort of flew in the face of what we did traditionally in TradFi. So I mean, I think it's fascinating. I'm still not entirely educated on it, which is why I need to come to events like this and get more educated on it. But you know, it's a real thing, and it's not going anywhere anytime soon.
Yeah, that's actually one of the most interesting things I think I found about crypto is that whenever I talk to anybody about it, even people who should be experts, they always lead with, you know, I'm not an expert in crypto. There are just so many different aspects, whether it's DeFi or stablecoins, or there's this litany of data that's sort of available. And David, like you sort of are looking at this data constantly, whether it's straight from the blockchain, whether it's anything. So what do you think are some of the most important bits to research as you're doing your due diligence? Like how do you go through when you are constructing a strategy? What are some of the new things that you look at?
Well, Taylor, I'm an expert in crypto. And so long as there are no follow-up questions on that, that's going to remain the case. No, I would say that there's a lot of information, and coming from the TradFi space, I think that one thing I had expected when I moved over to cryptocurrencies and covering this space, I expected everything to be fully transparent, and that we'd have all the data mark to market by the second, and we have all this available information on flows and on-chain analysis and everything. And it is there, but it is remarkably hard to actually mine. There's so much data, in fact, that I think it makes it really complicated to kind of get into this space to truly understand like what is driving the dynamics. And sometimes I feel like you look at a token and its value and you say, this is fairly priced, or this is actually a month away from actually pricing in the merge or pricing in a major theme that really should be in here at this point. And sometimes I've looked at the space and I'll look at a Chainlink or a Polkadot or a Graph and I'll say, like, this has got to be a cheap play, right? I mean, there's got to be some value here that people haven't looked at, and you kind of get into it and you say, actually, markets have this about right. So what do I look at? I look at tokenomics, obviously, and I think that's a very broad term at this point. It definitely encompasses everything from the total value locked of a project over to its circulating supply, over to what is actually diluting the supply of that. Is it being unlocked in certain places? You look at the flows and what is actually happening here. Ethereum has been a good one because over the last 9 weeks we've had outflows, and that has had a huge hit to the price relative to Bitcoin, for example. So it's taking that and putting it into a holistic picture to try to come up with some conclusions about what we can expect in performance.
Actually, I'm going to jump in here on this because I think I've been doing this now for 5 years. We started Arca 5 years ago, full service investment management firm just for digital assets. But like Liz, I came from TradFi, investment banking, bond trading, traditional debt and equity hedge funds. And I look around the room here and I'm assuming everybody has a completely different knowledge base right now of what digital assets are, right? Some of you probably have never invested, some of you are probably doing it longer than anyone up here. But this is typical of a conversation, right? We talk about everybody's interested in it, like Liz was just saying, right? We can see the 20 to 40-year-olds love this. And then we dive right into tokenomics and whether or not we should buy this. And most of the people are like, what the hell are you talking about? Like, where do we even start? So I think, like, before you even get anywhere in digital assets, you have to understand that, again, there are no experts, right? Even the people doing this 24/7 have at most been doing it for, realistically 4 or 5 years, right? It hasn't. 5 years ago, it was basically just Bitcoin and a couple of things that barely exist anymore. The market has evolved a lot. So you have to start peeling it back and start to be like, okay, what is this? Why are people fascinated in it? And it's, first of all, I don't even ever use the word crypto. I use digital assets because I think crypto is a tiny subset now of what digital assets are. So we spend a lot of time thinking about the taxonomy, right? It's easy if you're a debt investor or an equity investor or even a real estate investor, right? You have these very well-defined subsectors and taxonomies. But nobody's spent the time to really do that in digital assets. Like, I don't even think digital assets is an asset class. I think it's a technology that is now wrapping all asset classes, almost similar to an ETF, right? The first ETF was a S&P equity ETF, but now ETFs package commodities and bonds and different sectors and active managed versus passive. There's all these different things, and that's what digital assets are now too. So if you start with, like, first of all, who is the issuer of a token? right? You can have an individual issuing a token. You can have an actual corporation issuing a token. You can have a government issuing a token, a decentralized entity, a platform or a protocol. There's all these different issuer types that are very different from just Bitcoin or Ethereum, which is what most people come into and have heard of. Then you have to think of, well, is this a decentralized or is it a centralized token, right? Centralized meaning it's actually run by individuals, with a real board of directors, a real company, versus decentralized, something like a Bitcoin or Ethereum, which is, spread out with a lot of different developers and nodes and validators. And then you have to think about, okay, well, what is the token, right? Is it a cryptocurrency, which again is a small subset? Is it something like Bitcoin, which only has value because of supply and demand? There is no intrinsic value. Don't let anyone tell you there is. There is no intrinsic value to Bitcoin. It is just supply demand based on, do we think this is one day going to be a medium of exchange? But that's very different than, say, an asset-backed token, which is backed by real hard assets, something where the token is literally just a conduit to represent the value of something else. And then you have pass-through tokens, tokens that have usually some sort of hybrid characteristic. They might be part financial instrument where you're actually getting a dividend or some sort of a buyback from directly the revenues and profits of the business. But it might also have some utility value, something that gives you like member benefits or loyalty rewards for being a participant within a network. And then even beyond that, then you have sectors. You have DeFi, you have CeFi, Web3, NFTs, gaming. You really have to think through before you even get to who are the people who invest in this, why do they care in it, and does this token have value? You have to break it down into what are you actually trying to accomplish, right? What do these different tokens do, and why are there thousands of them that are so different from each other? And I don't know if there's any more ex-bond traders in the room like myself, but it really is more like the fixed income market than anything else. Tons of different issuer types, tons of different ratings, tons of different types from callable bonds, puttable bonds, convertible bonds, different seniority levels between secured, unsecured, subordinated, et cetera. That's what the token landscape is now, and you really have to look at it in a very holistic level before you can start just picking tokens off of a site.
So before coming on this panel, I promised my mom that I would try and make it as understandable for her as possible. I'm sorry, Mom, for that. Basically, it kind of sounds like you're describing a more venture capital-esque approach to analyzing an asset, where, yes, you have all these metrics that you can sort of look at, but there is a bigger way to sort of see things that includes, who's on the team, what it is that they are trying to accomplish, what the work that is being done or is planned for factors into that investment decision. I think the one bit, we were talking earlier about the involvement of sort of community activity and community interest in whether it's a token or a stock, and how that also plays a factor.
Yeah. Well, so I think the beauty of this is, I call it an asset class. There are probably people in the audience who call it a currency. I'm not ready to call it that yet because the use case for me is not that I go to the grocery store and I pay for my milk with Bitcoin yet. That's a currency to me. And then there's digital assets that encompass an entire other realm of things that we can talk about. As investors, when you look at the asset class itself, I think if I'm going to totally nerd out, I promise I won't do this for too long, but think back to traditional asset allocation and how did we used to do that? Why did we do it that way? We did it based on what was called modern portfolio theory, right? And you had this efficient frontier. You guys can look this up later and fall asleep. But this efficient frontier, and it was this curve that was the relationship between risk and return. And as long as you had a portfolio that touched the efficient frontier, you were doing it right. And that was the way that we used to talk about diversification and the way that assets moved together and the relationship of how they moved together. And that's why diversification worked. The problem with that whole thing in TradFi is that it made a couple assumptions. It made the assumption that all asset classes have a normal distribution of returns, so that thing called the bell curve, and that everything always acted that way, which, as we know, it doesn't. And the tails of that bell curve, I think, are what the digital asset or the crypto revolution really changed, because the tails got fatter, meaning the chances of outsized positive or outsized negative returns got higher. And the bell curve it also assumed that everything was always straight up and down, and you had this center point and it was evenly distributed. Obviously nothing is evenly distributed, especially in today's market where we've got this, I don't know if you guys have heard, but inflation is kind of high. So we've got this beast out there that's changed the way that we've done things, and we've got monetary policy that's changed the way we've done things. So it made this assumption that really no longer makes sense. It also made an assumption that we as investors are rational. I don't know how many, I mean, even on stage, right? I don't make rational decisions all the time, especially if it's my own money and I'm emotional about it, or I feel really passionate about a cause and I'm going to invest in that cause, right?
I mean, my pin
Irrational.
My pin here says diamond hands. That's
Right.
irrational, but it's, that's how I feel.
Exactly.
Yeah.
So the way that we used to allocate portfolios, or the way that we mathematically allocated portfolios in the past, just doesn't work the same right now. And it doesn't mean it's never going to again, but I think when we think about adding something like crypto to a portfolio, because again, I think of it as an asset class, it's about setting the right expectation for that particular piece, and then how is that going to act in relation to everything else in the portfolio. And that's the biggest challenge. When I talk to investors about this, that is the biggest challenge, because the luxury that we have of things like the S&P 500, or insert asset class here, right? The luxury that we have is that we have so many years of history to know how they act in different environments. We don't have that in crypto. So we can't set the same expectations. So I promise I will land this plane. To wrap it up, I think, when I talk to people, their biggest question is, how much money do I put in crypto? And the answer is, don't put your rent money in crypto, because it's still in price discovery phase. We're still trying to figure out how it behaves in different environments. And, public service announcement, this is a new environment of the last 40 years. So we don't know yet, and you still have to be careful with how you put it in the portfolio and how you set those expectations. So what TradFi got right was that diversification matters. We just don't do it the same way that we did 30 years ago.
I actually would love to comment on that, because I think when people think about this from a personal portfolio allocation perspective, like, you're right that this is a new asset class and things are done differently. But I also would say that there's a lot of traditional portfolio allocation that comes into play here. Like, the way you typically think about portfolio allocation is you think about your age, you think about your risk tolerance, you think about your liquidity needs. If you're 25, you have a very different risk tolerance than someone who's 75 with 2 kids. I was speaking before about how certain assets look cheap and certain aspects look fair value. By the way, I'm not telling you that those things are cheap. I'm using them as an example. So don't go out and be like, Coinbase said, just buy these things. I did not say that. What I'm saying is that we typically think about it in those terms, because we think about valuation and we start to say, oh, I want to get in here because I'm thinking about that short-term gain. I don't really think that if you're in this asset class, that's the way you should be thinking about things. I think that we are talking about long-term speculative assets that this is a long duration. They will perform over the long term because the secular curve for adoption is very steep. But it still isn't, you're going to need to weather volatility. You're going to weather periods like we are dealing with right now, because as much as this is structural, a lot of it's cyclical as well. So even though you may believe in that asset, you still need to think about in those terms. It's not simply going to be like, like the risk reward of this based on that.
Mm-hmm. I think it's also really.
It actually brings up an interesting transition into the turbulent markets aspect. You brought up inflation, outside of how everything is sort of affecting the portfolio and whatnot. Jeff, kind of wanted to lead with you here with a bit of a softball, but basically crypto was started in 2008. We had declining interest rates. It sort of continued to rise and become more popular as interest rates continued to lower and whatnot. Now we have rising interest rates. What's going to happen?
Well, I think you have to, again, think about what you're talking about when you ask these questions, right? We continue to just lump in crypto or digital assets as if it's all one thing, and it's just not true, right? Rising interest rates matter for a couple of reasons, right? One is if you're doing a traditional DCF model, right, and you have a very back-end cash flows, rising interest rates are going to raise the terminal value and lower the present value of that cash flow formula. So if you have something that has very long-tailed revenue, like tech companies, they do really badly in rising rate environments. But a lot of digital assets have no cash flows. That's not what they're built for, right? They're built in more of a currency or more of a utility, where in theory they shouldn't be impacted at all by rising rates, right? So rising rates from a valuation standpoint actually do very little. You could argue that most digital assets are actually recession-proof. And again, this goes back to that kind of hybrid model where you have a little bit of financial upside from the revenues and profits, but you also have this utility model, this participation, this member loyalty, right? If you have, Target gift points, those don't go down in a recession, right? You still have the same, points that you had before. It's sort of similar in a lot of these digital assets. So from a fundamental valuation standpoint, and yes, most digital assets can be fundamentally valued. Not all of them, not Bitcoin, but most of them can be. Rising rates actually do nothing. But from a sentiment standpoint, rising rates are incredibly important, right? I mean, we have been living now in an environment for the last 14, 15 years where the Fed dominates everything, right? I mean, I left my old distressed debt hedge fund simply because I was like, this is really boring. All we're doing is waiting every 6 weeks to see what the Fed says. And for the most part, digital assets weren't wrapped up in that until 4 months ago, 5 months ago. And now we're, obviously tracking the same things that the equity and the debt markets are. So I think it's a challenging risk environment. I don't think it actually has any impact whatsoever on the valuation or the future value of any of the digital assets.
So what would you guys consider are some of the biggest risks in the market right now? Not specific to any singular coin or network outages or mergings of forks or anything like that.
I mean, I feel like we're supposed to say something earth-shattering. The reality is the biggest risk is that we don't thread this inflation needle, right? And that we have a hard landing. But I won't spend too much time on this, but if you think about just what's going on right now in some of the indicators that we watch, I mean, the market started warning us last November that we were going to have a tough time. And then the rest of the market caught up starting in January, February, and said, yeah, we're going to have a tough time. And then April was really bad. And that's the timing of how this usually works. Macro indicators, the economy follows about 6 to 12 months after what the market says. So if you look at, it was November 19th, 2021 was the high in the NASDAQ. Fast forward, here we are, and finally the macro indicators are rolling over, right? The housing market has started to crack. We're seeing a little bit of a pullback in some of the activity metrics. Inflation obviously is a problem, yada, yada, yada. What needs to happen, though, is that that's a process, and as long as we don't break the consumer in the meantime, we can probably have a softish landing, where at least nobody breaks any bones when they hit the floor, right? But it's still going to be painful, and it doesn't mean it's going to be over anytime soon. So I think maybe the biggest risk is just everybody's resilience in it, investors' resilience in it. I think the biggest risk for investors right now is that we want the volatility to be over, and it's not over yet, and that people sell at the bottom. That's probably the biggest risk. And you lock in a loss, and then you've missed it. Maybe we bounce back in a couple months or at some point in the second half, which is my opinion, that there is a little bit of a recovery in the second half. I think the biggest risk is that you ran out of stamina for all of the stuff that's happened already this year.
So it kind of sounds like you're basically saying that, the way that these things have applied to the traditional stock market in the past apply in sort of the same ways to crypto in this existing market. Relatively, you just shook your head at me.
I shook my head because I disagree with a lot of that. I think the market right now is reacting very similar to traditional markets, right? And that's not because of the assets themselves, it's because of the participants, right? When the participants own all of the same assets, they're gonna buy and sell them at the same time, right? So you're seeing a very reflexive response right now. Again, rising rates, Fed telling you that inflation's getting out of control, everybody sells everything. That doesn't mean the assets themselves are necessarily correlated. It just means the prices right now and the reaction of the investor is very correlated. But again, I think this is why you have to separate out like what a digital asset is. And you're talking about like, can you dumb this down for your parents? I got 73-year-old parents. I dumb this down for them all the time. If they don't understand it, then clearly I'm not describing it correctly. But like, this is why I think digital assets are so powerful, even in a risk-off environment like this, is because you can have a much deeper connection to what you're investing in than say you do in the debt and equity market. And for example, take Amazon shares versus Amazon Prime, right? Most people are Amazon Prime members. You get all the member benefits of Amazon Prime. First, it was just free shipping, and then they added on all these cool benefits. You get Whole Foods discounts, you get free movies, free music, et cetera. But you can also be an Amazon shareholder and just have the financial upside of Amazon's success through their revenues and profits. You don't have to be both, right? You can be an Amazon shareholder and never use the product. You can be an Amazon Prime member and never own the shares. The digital asset world is combining that into one thing. If you are going to be an early participant or a user of a network, you're also going to be financially motivated to own it because you're going to get the financial upside of this business through the token. And there's hundreds of examples of tokens like this that do exactly that. Binance is a good example. Binance is, the largest exchange. Probably what, I don't know, 5 times the volume of Coinbase right now. It's the Coinbase of Asia, right? They introduced a BNB token. It's a very similar company to Coinbase, but Coinbase doesn't have a token. When you are a user of Coinbase, you're just a user. You may not own the stock. In fact, for the first 6 years of Coinbase's life, nobody could own the stock except for venture capital investors because it was private. But if you were a Binance user, you also own the BNB token. And by doing that, you get discounts on trading. You got to use the BNB token as collateral on their exchange for trading futures and options. You got discounts when you traveled throughout Asia with partnerships like they had with Travala. You could use the token to get first in line for new tokens that they were offering. There was a real utility benefit to BNB, the Binance token. But they also gave you 20% of their profits by buying back the tokens. So all of a sudden, think about it. If you're a Binance user, you have brand loyalty for life. You're going to be an evangelist of Binance. You're going to be a power user. You're going to tell all your friends and family to use it. You are immersed in that ecosystem while also financially benefiting from it.
So
Whereas Coinbase, you could be just a user or just a shareholder and not both. And again, Coinbase is a US company. It's very different. I'm not trying to pick on Coinbase. They can't do it because go back to the last panel, the US regulatory environment's a mess. But they couldn't do this same thing. But the companies and projects that are doing this are combining your financial upside with your interest in the company, and that's incredibly powerful, especially when you get into the 20 to 40-year-olds who care more about experiences and what they're doing than just financial upside.
Yeah, I think that brings up a very interesting point that intrinsic to investing in crypto is actually that you should use the product that is being made in some form or fashion. See whether it works well or whether it works poorly. And there's a lot of user risk that is associated with that, just in terms of all of a sudden being your own bank means you have to do your own research like a bank. You have to understand how global things are affecting the market like a bank would, and really sort of protect your risk in the same way. So, cool. All right, well, I think that's about our time. But thank you, everybody. I think we came away sort of with this idea of, yes, crypto is definitely affecting the global financial sort of markets and how they work and how institutions are behaving. We've got some idea in terms of investing sort of like a VC in that model. And yeah, I think we're good. All right, thank you.
Thank you.